welcome.
Hey, thanks for having me, Rob. Nice to see you.
Likewise. And, in preparing for this conversation, I looked back, and over the years that you and I have chatted together, we've talked a lot about what I've heard you refer to as tension problems. So, decision-making speed versus depth of analysis, or how to balance between conviction and humility, or being patient versus being agile. And it strikes me that today, a big one is just how do you weigh a long-term mindset that's so important in investing with the real-time developments that, it's just the end of January in 2026 here, and there seem to be so many that perhaps don't seem to simply be short-term noise. So a big question to you to start, can you walk us through some of the major forces as you see them that are shaping markets today, and what kind of a change do you think they represent?
That's a great question, and it's a big question. And so I'm going to head a direction that's probably not really expected. A few years ago, I was inquiring about what Shakespeare was writing that could provide some insight into what's going on today. And because I find that if you read fiction and you read history, you learn a lot about humans. One of our summer students actually had recommended a play called Coriolanus. And that is maybe not well known by people. People are more familiar with Hamlet, but it's a play that's probably Shakespeare's most political. And it's hugely insightful into the challenges that humans get themselves into that occur over and over and over again in history. And that play was essentially, it was sort of placed in like the Roman state before Rome was an empire, maybe 500 BCE, and was really kind of the tale of the secession of the plebs. But what's telling of the play is the first scene is like riots at the granary. And that is just so insightful into human problems because it shapes the have versus have not question and the tension of economics that has always existed through humanity. And what follows is politics and then conflict. And so I just find that that is such a brilliant template for thinking about all these things that have occurred in the world. And you think, oh, well, this, like, why do we have this tension? It's different this time. And it's like, no, people have been struggling with this for a long period of time and writing about it. And it happens over and over and over again. So economic tension first, and then politics and conflict. Interestingly enough, I was reading the other night a biography on Jerusalem. And this is a live, again, historical event. Apparently, Jerusalem was besieged by the Romans in 70 AD. And the reason for that was there's like riots and a lot of conflict, and Jerusalem at the time was like this vassal city, and they had expelled the Roman garrison through the riots, and basically the Romans had to come and they effectively had burnt the place down. It's one of the times that Jerusalem has been burnt down. Before that, leading up to that event of the Romans coming in, throughout the riots, one of the things that happened, and of course, again, economics is involved in this, but one of the things that happened was that the debt records were burned down by the rioters. So add another theme in terms of, economic tension, class divide or economic inequality, politics, political change, conflict, and then this concept of debt jubilee. So these are like recurring themes in history that we've seen before and we're trying to grapple with. Now, if I just go down the rabbit hole in debt jubilee, Jubilee comes from a Hebrew word, and it actually it appears in the Bible, the Old Testament, the book of Leviticus, and it means the Hebrew word Jubilee means ram's horn. And so apparently every 50 years or something, people would come out and blow the horn, and that would be the Jubilee. The slaves would be let free, and if you had debt against your land, that would be wiped out, and the any personal debts would be wiped out. And so this concept of debt jubilee to kind of make up for this original economic inequality goes back a long periods of time. It has its roots in the Bible. Actually, before that, it has its roots in Mesopotamia, or I guess present day Iraq. And there's a tie in there because the Babylonians, the city of Babylon, I'm not a historian, so you'll have to excuse me, but they actually, before the Romans sort of besieged Jerusalem, they did the same thing. So anyway, round and round we go in circles in terms of humanity. So why do I bring all of this up is because, you'll hear economists talk about this K-shaped recovery we have, the struggles of one class of the population. That's been leading to political change and kind of some more extreme politics. That's been leading to more conflict, geopolitical change. And you're seeing evidence or milestones of, this debt jubilee popping up, right? Like in New York, you're hearing about, well, maybe there can be a millionaire's tax. The same thing was going on in California for billionaires. That's going to go to vote. Even in Switzerland, it got shut down, but there is like a wealth tax or a more substantial wealth tax proposed. And, that's previous to this, you would have characterized the modern day debt jubilee as basically financial repression. You have some inflation, but you lower interest rates, and it's like a very silent tax or a silent debt jubilee. And the system moves forward. But that's the backdrop. That is a big historical backdrop. And the truth is, Rob, it's very different. When I came in to run the global equity portfolio back when we launched in 2009, and you think about that 12 years, or when I was the lead portfolio manager before I came back in, and the big chunk of that was during back-to-back Barack Obama administrations in the United States, where it was sort of the Pax Americana rules of play. You had a security umbrella globally, free trade. You still had the structure of the Bretton Woods agreement in play. All that has evolved. And we're thinking about it. We're cognizant of the change. That's what I want clients to know. And I think, one more thing. I'm going to steal from a speech that Mark Carney delivered. If you haven't seen his recent speech at Davos, you should. It's great, but he has a line there that's just so good. Nostalgia is not a strategy. And as we head in this generation, even though the core of what we do, the concept of competitive advantage and valuation and management teams and people, even though that's still so vital to how you invest, but the execution of it has to change a little bit in this new environment. So that's a pretty big monologue to start off on that question. On my mind.
Well, I did ask a big question, and I'm glad you brought up the Prime Minister's speech, because another part of the speech was just this notion that there's a rupture, in his view, occurring today. But I think behind that was this notion that, hey, whether it's the rules-based international order or other big things in the world, there had been a waiting for some time. To your point on the K-shapedness of the economy, that hasn't accrued all of a sudden. that's been building for years. Or I'd love if you could comment next is just, how do you view those tipping points between, hey, a pressure is building versus, okay, we're on the other side of it now?
I'm not quite sure how to answer this, but maybe I'll start and you can guide me where you want to go. Capital markets evolve, economies evolve, economics, it's an evolutionary process, and things aren't black and white. And so I think you have to see the information comes in, and you have to evolve the portfolio and evolve what you do based on that new information. And just to give you an example of that, I think that what happened recently with the operation in Venezuela is a little bit of a tipping point. And you could see it in the reaction over time in gold markets, which is extremely volatile. But there's a reason why gold prices are doing what they're doing. And there's a reason why that sector of the economy is now a lot more wealth creating than it was in the past. And so you have to evolve. If you go back on the internet, you can find maybe it wasn't a podcast, it was probably a blog, but something that we put out again during the Bretton Woods, Pax Americana sort of geopolitical regime, probably during when the Obama administration was in power, where I had made the comment that gold was for pirates, not investors. And that's starting to change because traditionally gold has been a great store of value over more extreme periods of time where you don't trust the fiat currencies in place, which are ultimately a reflection of the debt that people have in place and the trust in those governments. And so we're shifting, we're evolving. It's not a 1 or a 0. We're not sure if we have this right, but you have to evolve with the environment.
One of your colleagues, or our colleagues, Peter Lampert, shared something a couple of years ago that really stuck with me. It was this notion that, hey, don't let a label, meaning I'm a long-term investor, get in the way of making decisions that are more agile if things do in fact change. Have you found your own portfolio management style, just comparing today to those prior regimes, like you talked about in the Obama administrations? Has your style as a portfolio manager had to change as a result? And if so, how?
Yes, absolutely. And, we did a podcast together a little while ago where, we didn't focus on the geopolitics of it, but I told people that we were going to stand in the middle of the net. We were going to have a more diversified portfolio that was going to look like more names, more different sectors and subsectors, given the more uncertain world. Again, nostalgia is not a strategy. When in that previous era, buying a series of software companies that were creating wealth and inflation was low and there was less geopolitical pressure, that worked very well, but we were having to evolve that. And so the way that I'm looking at portfolio construction is you have a much broader, diversified portfolio. Your positions are smaller, so you're more agile. You still shift and allocate capital and lean based on our principles, but you recognize that the outcomes are maybe more extreme or material and different from each other. And you have to be in multiple spots at once. And so that's why the way that, and we haven't talked about technology yet and what's going on with AI, but that's this other overlying factor. The economy is evolving and speeding up in terms of technological development. We have to be there. And we have to be prepared for the scenario where that doesn't work out. And maybe the opportunity is more so in pharmaceutical companies. Or maybe we have to be prepared for the event that there's just more conflict in the world. And that's why we're investing in some defense companies. And likewise, recognizing that if there is going to be some kind of more radical debt jubilee, well, what will that due to, say, the price of gold that's traditionally been a store of value. And you can see why there's wealth being created within gold miners and why we're positioned that way. So, yeah, that is the big change that we're making. And I think there's still an excellent opportunity to broaden that set of wealth creating companies, be pragmatic about how the world works, and then allocate capital within that and shift with the odds the same way we have been in the past. But a lot of what we're doing is about portfolio construction. That's where I'm emphasizing my time. And it is a different regime, and you have to have a different playbook than you had 10 or 20 years ago.
Can you comment on just the nature of bottom-up work? So, much of the discussion so far has really been about, top-down thematic, or just thinking about thematic ways in terms of managing a portfolio. And I understand that you're focusing those remarks on the portfolio management aspect. But what does bottom-up investing look like in today's age? Has that changed?
Oh, I don't think that's changed at all. You still have to do the bottom-up work, right? Like, I know for some of the, for example, the gold companies we're investing in, you still have to know their cash cost per ounce of gold. It might be $1,500 to $1,800 per ounce, and they're all in capital, cost with their return on capital might be a little over 2,000, and you have to understand supply and demand and recognize there's close to 5,000 metric tons of supply and equivalent of demand, and 25% of the supply is actually recycled gold, and about half of the demand of gold is buying gold bars at Costco and central banks and ETFs. And those two basically have a tug of war. The other half, by the way, on the demand side is jewelry and technology, mostly jewelry, 47% or so. So all that, you still have to have a concept of, you have to understand the balance sheets of the company, the operating leverage involved, the pros and cons of each investment. But then portfolio construction and your overall risk management is just so vital because of the overall geopolitics and volatility that we're seeing. So you have to work with both sides of the equation.
Is it the case too then that portfolio construction considerations are really driving idea generation on a bottom-up basis?
Not necessarily. It depends on the situation, right? Just take an example. We've invested in some memory stocks. Memory is a bottleneck in the AI value chain. And there's been substantial both volume increases and price increases. And so the bottom-up work is still understanding the overall cycle. This is still a more cyclical business, recognizing that these companies are going to create more wealth during what looks like a super cycle, estimating the sensitivity of how much the economics will move if price moves a certain amount, understanding the supply that's going to come on, what's going to come on in terms of greenfield expansion or brownfield expansion. But then you have to look at it from a portfolio perspective and say, okay, well, we're still building diversified portfolios. So how much is too much? How do we want this semiconductor exposure? Do the odds of valuation make sense? Should we be leaning a little bit or not at all? How much cyclicality do we want to have in the portfolio for our clients? How is cyclicality or risks offset by something else in the portfolio that is a natural contradiction and might cancel out risks at the portfolio level? So it's both sides. Sometimes it's tough to determine, which side you're leading with, because the conversation is about portfolio construction and it's about bottom-up construction. We're having both of those conversations at the same time.
You mentioned AI as a theme that we actually haven't spent a huge amount of time on in this particular conversation.
It is just, and it throws fuel over the fire, right? Because, not only do you deal with how real this is. And there's obviously, I mean, this is some amazing technology. Like you just can't doubt that. It's a question of what your ROI is and how long it takes to develop and how far you go. And so the risks of it at the portfolio, it's like your most recent best historical example is in the late 90s, what happened with the internet boom and bust. And, some of the risks are valuation. You just get people speculate too much and valuation is unreasonable. Another risk is just build out. You build out too much capacity and then it's deflationary for a bit. And so there's a risk with that. But then you have this other very real, interesting dilemma. And for those who have started to use these different tools is you really are more effective. And you can see how as they improve, you're going to be able to do more with fewer people. Now, why do I bring this up? Because back to our Shakespearean play, Coriolanus, the ability of fewer people to do more can start to create an even greater wealth divide and create more problems politics-wise and conflict-wise. And so people are really wrestling with, I think, what this means and even how you run your organization. I think the best example, if you imagine how most companies run summer student programs, and just think about you hire your summer student. Everyone kind of knows when you're a summer student, it's like you're learning. Like you're not providing a whole bunch to the company at that point, but you're investing in summer students because eventually you're going to train that person up and maybe you can hire them and there's going to be a point where that person adds more value to the organization. I think the way to think about it is AI is going to extend that. You're going to have people that might be in quote unquote the summer student role for a long period of time where a more senior person can be using AI tools to do their job at scale, whether it's programming, whether it's law, whether it's finance. And it's going to put pressure on hiring new people. And there'll still be tons of jobs that are created. People are going to invent all sorts of things. Humans are very creative. But the strategy will change because you're going to need to hire people for succession and to develop, but you're not going to need to hire the same amount. And there's a big question of, well, what does that do to the employment rate? And like, what does that do to society? And just imagine, just take the example of like software had been for the last, a couple of decades, eating the world. And imagine how many programmers got wealthy by sharing in the success of that sort of capitalist venture. And now that may not happen to the same extent. And in fact, a lot of those jobs are going to be reduced. So, that's one of the, aside from the investment implication, the direct investment implications, there's kind of this second order effect of what AI could do to society that I think people will grapple with longer term.
Paul, there's a section of our listenership who are people out there, perhaps they're in university, super interested in investing, trying to find roles. I'm just curious, based on what you just said, what advice you might offer them in terms of where the role of an investment analyst or portfolio manager, decision maker is going?
Well, I think the job evolves. So, I can just share with you what we're doing internally is there's a lot more use of AI for efficiency and sort of if you would have imagined even 10 years ago, like the job was of the analyst was to go out, collect data, collect the information, put it in a framework to analyze the company and the industry, present a report to the portfolio manager who would then ask a bunch of questions and that analyst would go back and get the answers to those questions and the portfolio manager would make a decision. It was sort of probably a more linear process. And now what you have is you can have that conversation with Gemini, and you can have that conversation with Chat GPT. And if you know the right questions to ask and dig down, a lot of that data collection is going to be commoditized. And a lot of that analysis that can be that's part of the public knowledge. So my advice to aspiring investors, finance people is like, you still have to learn that sort of stuff, but learn how to integrate with AI, be creative. That's going to add value. Judgment is not going to go out of style. Judgment is just not going to be cannibalized. So that's something where you develop. And along that same train of thought, information that leads into judgment and where that information is scarce and valuable, that's really important. So the way that we're developing is like we're developing more AI and technology tools, but we're also spending more time on insights probably that relate to deeper conversations with people and management teams. And you sort of, the strategy ends up bifurcating, if you will. But it will be different. The job is different now, and it'll be even more different in the future.
I want to go back to where we started, which was these big forces. And you took us on quite a circuitous path to understand them. But if I pull a couple of learnings out of that or just key insights, it's one, read, be a student of history. Things that are happening today do rhyme with what's happened in the past, whether it's the recent past, but often, much, much longer in our history. We are human after all, and we do share that with those who came before us, whether it was a couple decades ago or thousands of years ago. Don't just read, read fiction as well. There's lessons in there that are worthwhile too. So it's not just about business books that you want to be reading. But, your comment on judgment had me wondering too. We've talked a lot about what's changing today and what that might mean for investors. What's the same though? What hasn't changed?
Humans, fear and greed. And so that's why Rob, it'll be the exact same. People will get scared, people will get greedy, and that plays out in the stock market. And that's why judgment is important. That's why process is important.
Or to go back to Shakespeare, what's past is prologue. Very good, Paul. Fascinating as always. Thank you.
Thanks, Rob.